Welcome to Invest with Jiri. Today we'll answer some questions about China. What is the economic state of China? Why is China's economy slowing down? Why are Chinese companies so cheap? Will China's economy growth in the future? Or how to invest in Chinese companies? What is the economic state of China? First, let's look at the debt levels of the Chinese and American economies. China's public debt to GDP ratio was 77% in 2022, the highest China has ever had. In contrast, the US public debt to GDP ratio is 129% in 2023. The debt to GDP ratio beautifully shows that China is not as bad off with debt as the US. Is inflation in China as high as in the US? During June 2022, inflation peaked and reached 9.1% in the US. However, China only had inflation of 2.5%. In January 2023, inflation in the US was 6.4%, while China had inflation of only 2.1%. From this example, it is clear that China has managed to manage inflation smoothly, but we cannot say that about the US and the rest of the world. Let's look at the economy through the index of China's 300 largest companies. As of February 2021, the CSI 300 index is down minus 35% from 5,700 to the current 3,400. The CSI 300 is an index of China's 300 largest companies that displays the sentiment of the Chinese stock market in a single price chart. If you add the SPX index of America's 500 largest companies to the chart, it is clear that Chinese stocks are having a tough time. Why is China's economy slowing down? China's formerly breakneck growth, built on investment, cheap labor and exports, has reached its limits. Economic, social and environmental inequalities have emerged. China's economy is facing a structural slowdown due to unfavorable demographics, rising growth constraints and rising debt. China's economy grew by 8.1% in 2022, the fastest pace in a decade. But in 2023, the economy grew only 5.6% less than expected. Growth has stalled, youth unemployment is at a record high, the housing market is collapsing and companies are dealing with recurring supply chain pain. Growth is also being held back by trade tension between China and major economies such as the US. The yuan is on a track for its worst year in a decade as its exchange rate plummets against the US dollar. The weak currency is spooking investors and increasing uncertainty in financial markets. This also makes it harder for the central bank to pump money into the economy. Why did Chinese companies have to leave the US stock market? The reason was new regulations that limited the influence of large tech companies and increased control over data and citizen privacy. For example, Didi Global or China Telecom left the US stock market after being accused of violating data privacy laws. Why are Chinese companies so cheap? In a global context and compared to the US, Chinese companies are now very attractively priced. For more than a decade, Chinese stocks have traded at a discount to global market stocks. Investors have to consider many risks, for example, regulatory, economic, currency and political risk. Compared to Chinese stocks, US ones trade at twice the future earnings. Last but not least, the market in China is underperforming the US market and investors are much more cautious than they were a few years ago. For a better idea, let's look at the three largest Chinese companies on the chart. Alibaba Group Holding Limited, ticker BABA. This is a multinational conglomerate specializing in e-commerce, retail, internet and technology. Tencent Holding Limited, ticker TCEHY. It is a major technology company known for its social media, gaming and entertainment platforms, including WeChat and various video games. China Mobile Limited, ticker 941, is one of the largest telecommunications companies in China, providing mobile and fixed voice services. Will China's economy growth in the future? There is a consensus in China's policymaking that it wants to continue to grow. Therefore, the central bank has been loosening interest rates recently in order to jumpstart the economy. Regulation of big tech companies is ending and more stimulus is in the pipeline to boost China's growth. There is no doubt that China will grow. Huge population, growing middle class, hardworking people and ambitious government plans. China is a global player and thinks long term. They are building infrastructure, developing their own technology and innovating at breakneck speed. This means one thing: China's growth. Investors who follow China over the long term know this well. How to invest in Chinese companies? Personally, I would invest in Chinese miracle using ETFs, exchange-traded funds. ETFs offer a basket of stocks of the largest Chinese companies and the investor takes less risk than if he bought one or a few stocks. The risk of one company going bust, the government imposing devastating regulations, or being delisted from the US stock market is eliminated. I have selected several ETFs that are focused on Chinese companies. The list could be longer, but I picked a few ETFs for illustration. All of the tickers on the list are traded on New York Stock Exchange, and as you can see in the chart with the prices, they move more or less in the same price channel. The fluctuations in prices are due to the different composition of the individual stocks held in the ETFs. Some ETFs focus more on technology, while others focus more on the overall economy. Personally, I would only invest a few units of 1% of my portfolio in Chinese companies. I would probably be reticent to invest in Chinese companies, but the potential is there. I would definitely consider dollar cost averaging, which I think is a great strategy in today's turbulent times. Thank you so much for watching to the end of the video. If you learned something useful here, give the video a like and I look forward to see you next time. And please, invest wisely.